I'm sorry, what? Hey guys, what is up? My name is Ayo and I'm a lifestyle blogger. Thank you so much for tuning into this video. I very much appreciate it. Today, I'm going to be busting those jargons for you. Is it jargons? I think it's called jargon. All those financial terms, all those words that you hear on the news, that you hear from those financial gurus that you have no idea what they're talking about. Baby girl, I was where you are. And today I'm going to define them for you and hopefully put them into context to help aid your understanding of investing and of personal finance. So if you're interested in that, please make sure you keep on watching. Today I'm going to take you through a few basic investing terms or financial terms that will help aid your understanding of everything you need to know when it comes to investing. It's going to be the first part of, the busting of jargon, if you like. So make sure you stay right to the end to understand all of the definitions. And if I don't go over anything that you are a little bit, unsure of, make sure you let me know down in the comments. I'd be happy to define it or create a new video to do more jargon busting for you. I am really excited for this video because lately I've always wanted to be a teacher, So I'm just gonna quickly put on some trousers and then take you guys through some of these definitions. Okay, so I've brought you guys in close and to the wall behind me, and hopefully I'll be able to edit all the terms, and if I don't, it'll be awkward because it'll just be blank, but it's fine. So I'm going to go over basic terms today. Like I said, we'll go into more detail in some more videos that are to come, but I think before I get started on busting mutual funds and ETFs and them, man, it's really important for me to be able to give you these terms that are, I guess, the foundation of finance, the foundation of investing, and the foundation of just understanding what we're about to talk about. The first word I have for you guys today, class, make sure you're listening, I'm so excited, is the word invest. Okay, investing. What is investing as a basic term? To invest means the process of putting money into something with a hope of getting more money out eventually. So the idea is that if you have a little pot here, you have some money, you put some money in with a hope that over time, eventually you will get more money than you put in out. So investing is very, very key, especially during this time. And if you are unaware of why investing is so important, especially now, especially considering everything that's going on with the Bank of England base rate, with inflation, make sure you check out my video up here where I talk about the importance of investing and why low-key we need to stop saving because it's not going to help us in the long run. But for the purposes of this video, investing is just the process of putting some money in to eventually get money out. And in that video, I also spoke about the different types of things you can invest in, such as stocks and shares, such as bonds, investing in yourself, investing in your well-being, also investing in black businesses. There's so many different ways that you can put money in something with the hope of eventually getting more money out. And it's very important and very key for everyone's personal finance journey. The next term I have for you is inflation. Now, inflation is so important, and again, a really important reason why we have to invest and why low-key saving isn't getting us anywhere. Inflation is the general increase in prices and the general decrease of the purchasing value of money. That basically means, or is the definition of what happens to us as a general thing. It happens in society, it happens no matter where you are. Prices increase, and therefore, as a result of prices increasing, the value of money decreases. Inflation basically measures that increase in price. And so because of that, if you have £1 that you've saved in 2020, you put that in something. If it's not worth more than £1 the year after or the year after that, it's only buying you less things than it could the year that you put it in. Therefore, the value of it has gone down. It's not worth it. When you invest money, you're trying to beat inflation. You're trying to increase the value of the money that you've put into something as a higher rate than what inflation is. And that's why investing is so important. Because if you put money in a savings account, for example, the chances are the interest rate in there is not going to give you a return that is worth putting the money in there. So it's always worth investing in something that you think will give you more money in the future going back to the investment definition, and therefore beat inflation and therefore increase the value of your money. Hey class, I hope you're still with me. I hope you're still looking at the board. If you're finding it helpful, please make sure you give me a thumbs up. It helps me out and could help many other people out too. The next definition I have for you guys, the next term, the next jargon that I would like to bust for you is interest rate. Interest rate. Do you know what interest rate means? Basically, an interest rate is the percentage charged. Wow, that was a mouthful. The percentage charged on the amount that you either borrow or that you save. Now, when people talk about interest rate, they use it in very different scenarios. So I'm going to try and provide the context of which you will hear interest rate. Now, first of all, there is the Bank of England base rate. That is a rate that the Bank of England set for basically the country, or for the banks, if you like. And a lot of times that is what high street banks, your high street lenders, are going to base their interest rates on. So that's the Bank of England base rate, which has recently gone down to a very sharp number of 0.1. And therefore the interest rate that all the high street banks are giving us are chicken change, if that. They're very awful because of the Bank of England base rate. And the reason why the Bank of England base rate is so low is because they're trying to encourage people to spend to kickstart the economy in, light of the financial crisis, in light of coronavirus, everything that's going on. They need us to spend more. And so the Bank of England sets that base rate, the high street banks set their rate, and that rate is what they will either charge us to borrow money or what they will give us back to save money, if that makes sense. So in terms of borrowing money, think of a credit card. If you have £100 on your credit card and you have got a interest rate of 34.9, I always use that. That's basically charging you £34.90 to borrow £100 on an annual basis. That is a lot. That is a high interest rate. And it's the idea that that is the amount they're charging you to borrow £100. Now, if you flip that back and you were to get a savings account, which is going to be unheard of, especially in this scenario, you were to get a savings account with an interest rate of 34.9. That would mean that for every £100 you put in there, they're giving you £34.90 to save the money and effectively borrow the money from you. Now, interest rate is so key. It's because the interest rate is so low that is not worth saving right now. I'm sure you and many other people have received an email to tell you that essentially your bank is reducing the interest rate on your savings account, and you're thinking, whoa. What is it worth putting that in there if you're not even paying me any reason to save it? And so because of that, it's very important to understand what the interest rates are. It gives you an idea of the economy and whether it's a good time to save or whether it's a good time to spend and invest. And I can tell you that right now, based on the Bank of England base rate, based on the interest rates given by banks, now is the time that we need to invest, because like we spoke about in inflation, the amount of return that you're going to get in savings account is not worth it. It's not worth keeping it in there, so it's worth investing in it in the hope that more money will eventually come out. I hope you understand it, but if you need any more clarification, definitely let me know in the comments. Now, the next term I have for you is something that you may have heard, you may not have heard, but it's very important for you to understand if you want to begin investing, and that is risk appetite, also known as risk tolerance. Risk appetite is basically measuring how confident an investor is in taking risk. How comfortable are they in taking risk? Think about it, appetite. How much do you want to eat? How much risk do you want to take? Think of it in terms of that. When you talk about risk appetite, it's normally in relation to maybe something institutional, like an actual company, and risk tolerance is normally in relation to an individual investor like you or I. So in order for us to understand or to be able to be comfortable investing, we need to make sure we know how much risk we want to take. Considering all those type of apps, like think of your money boxes, your nutmegs, a lot of times they will ask you questions and ask you how comfortable you want to take risks, because the idea is that most times if you take high risks, you will eventually get high returns. If you take low risks, you're likely to get low as returns. And in terms of your risk appetite, your risk tolerance, a lot of times that fluctuates with age, with your income, with your situation, what you're dealing with in life. And the reason why I wanted to talk about this term today is because what is your risk tolerance? What is your risk appetite? It's important for you to know that so that you know what type of things that you want to invest in the future. For example, if you have a high risk appetite, you don't mind seeing your money go up and down and fluctuate quite heavily, then the chances are you'll be great investing in stocks and shares, because a lot of times that is one of the riskier ways of investing money, especially in individual companies. And that would likely work for you. Whereas if you're somebody that, maybe you're only investing on a sort of short-term basis, maybe only for the next 5 years, maybe for the only next 10 years, then the chances are you may want to keep your risk a little bit low because you don't want to lose too much money in a short period of time. Therefore, you're probably likely to be better investing in stuff like bonds. And all those things I've just spoken about, stocks, shares, bonds, don't worry, I will eventually define it for you in another video. Do you have a high risk appetite, a low risk appetite, or are you a little bit in the middle? Very important for you to understand that so that hopefully you'll be able to make more informed decisions about your investments in the future. The next term I have for you that is very important but nobody seems to ever want to talk about is a pension. What is a pension? A pension is a pot of cash that you and your employer, or whatever situation you're in, but you and your employer pay into, that you will use for yourself in retirement age. So after you retire, what money are you going to be living on? It's likely to be your pension. Now you can have a private pension, you can have a workplace pension, and you can have a state pension. Those are things I'm not going to go into today, but just for the purposes of this video, that is what a pension is. A pension is very, very, very important. You guys need to think about it this way. When you are at retirement age, say it is 67 or 68, at 68, what money are you going to live on? Tell me. If you don't have a pension, what money are you going to live on? Or do you want to work for the rest of your life? I doubt it. So it's very important for you to be putting money into your pension, which is, by the way, tax-free. So you don't get taxed on that. You and your employer put money in with a hope that it will pay for your retirement in the future. Think about it this way. If you don't have much cash in your pension, you won't be able to order a takeaway. You won't be able to go traveling in your old age. All that sort of things won't be able to happen because you literally do not have enough money, or you'll have to go back to work. And if you don't want to do that, it's very important for you to be investing into your pension from now so that later on you'll have enough money for you to live comfortably without having to go back to work. So pensions are very important. Pensions are all part of investing as well. The chances are if you put money into a pension, there is somebody that is investing that money for you. It's all part of investments. It's all under the same bracket. If you are not paying into your pension, if you think that you can opt out, don't do it, baby girl. Please opt in. It's very, very much needed. Well done. You are now on the last term. Well done, class. And the last term I have for you guys, or the last two terms I sort of come hand in hand, is emergency fund and sinking fund. Now, these terms are something that I only learnt, if I'm being completely honest with you, a few minutes ago, in the sense that an emergency fund and a sinking fund are not what I thought they were when I first heard the terms. I thought they came hand in hand. I thought they were the same thing, but I can actually tell you they are not. Now, an emergency fund is money that you put aside in case something unexpected happens. It's the idea of putting about 3 to 6 months of your outgoings, 3 to 6 months of your bills, things that you tend to spend money on a regular basis. You put that away in case something unexpected happens. Like, for example, you are made redundant, or you lose your job, or something unexpected happens. So you put that money away for an emergency. Now, a sinking fund, I thought a sinking fund was an emergency fund, but that is actually not that. A sinking fund is money that you put away for something that you know you will have to pay for in the future. So I'm talking about things like a car MOT, maybe, your dental bills or something like that. Something you know is coming on the horizon, but you're putting the money away bit by bit so that when that time comes, you won't have to use your credit card or use a high cost way of paying for that thing. Like for me, I think I spent about £50 on an MOT. Say, for example, I know that's coming up in the next 5 months. I just put £10 away every month in a hope that when that time comes, that money's going to be there and ready for me. And the reason why I wanted to talk about emergency and sinking funds is because I think that those are two things that you should ideally have before you start investing. Before you start investing, you should have an emergency fund so that hopefully, if anything were to go wrong, you do have an instant, easy access way of getting that money. And if you also have a sinking fund, you are prepared for the next year's outgoings, for the next year's costs that are about to come your way. Any money that you have after those two things is what you will use to invest. So the money that you may have used to save for something, if you're not saving for anything in particular, if you're not saving for anything that is coming up very soon, you use that extra money to invest in the hope that you are, about to get a return later on in the future. So I would say for anybody that is interested in investing, ideally you need to have some sort of emergency and sinking fund before you start investing a lot of money. Now, that is not to say that without those two things you shouldn't invest at all. I'm not trying to say that. I'm not going to allow you to procrastinate on me. Don't procrastinate on me now. It's important for you to invest a little bit and often. That's a really good way to get started in investing. So even if you don't have your full emergency fund, even if you don't have your full sinking fund, even investing as little as 10p a day could be really helpful and would allow you to benefit from things like compounding. I wish I could define compounding for you today, but unfortunately that is the end of the video. If there are any other terms that you want me to define or help explain for you, please make sure you let me know down in the comments. It will very much help me out and allow me to make sure that I'm serving you. If you found this video useful as well, please give me a thumbs up and subscribe for more content. And I hope to see you in the next video. Take care. Bye.